With the pandemic taking a toll on the world's economy, the Bank of America is put on through its most horrific situation since 1929 when the stock market crashed, affecting millions of lives in the United States. Is it possible that we'll meet the same fate as we did in the past? Well, stay tuned for more. What's good, you guys? This is Market Thrive, and today we are going to talk about the assertion of the bank's currency strategist Athanasios Vampakidis and what the ninth cycle of the financial crisis will entail. Before we start this video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. First, Athanasios Vampakidis reminds us that disorders associated with the health crisis have been increasing in Europe over the previous few weeks, spiking last week. Theorist Vampakidis admits to being worried about more illnesses spreading around Europe as a result of the reopening. The theoretician also notes that there has been a significant decline in the Eurozone in recent years. It provided evidence in support of the idea that the initial rebound was simply the result of the lockdown's initial impacts, and that future, cleaner data would reveal a weaker recovery and output that was significantly lower than before the crisis. US figures show that the US economy has also started to worsen, and economists anticipate that this fall will see more of the same. The third red flag is that the market disapproved of the FOMC minutes from last week because they weren't dovish enough. Even though it was emphasized in the minutes that Fed policy will depend on the outlook, the widespread anticipation was for a sharp, conditional dovish message. According to the specialist, markets are actually pricing a loose monetary policy and a strong rebound, both of which he believes to be implausible in all three cases. But it was before a halt in risk assets was brought about by the three red warnings. In the interim, stocks in the US reached a record high last week, and they also did so in the rest of the world according to him. However, there is currently no budgetary agreement in place in the United States, and certain benefits are now past their prime. He currently thinks that the macroeconomic support will only be effective to a certain extent and that the global economy will remain weak and fragile. But the markets are optimistic about both potential outcomes. Although the real economy is unstable and the outbreak's recovery doesn't seem to be a aurora, there is a chance that it is still feasible, which is why the confidence is obviously strongly tied to the Vampakidis questions. What then would prevent the monetary and fiscal policies from supporting risky assets going forward? Real output is currently much below pre-crisis levels, and forecasts suggest that it will continue to be so into the following year or even the year after. Global markets appear to have nearly entirely recovered as a result, but deflation rather than inflation is the real worry. Therefore, nothing prevents the implementation of the extra fiscal policy stimulus funded by the increased money production. He asks a lot of questions that make you think. First off, why stop there? For just two of many possible examples, repairing the economy after a pandemic is very much more crucial than addressing issues like climate change or rising income inequality. This highlights the question, if we are already implementing modern monetary theory, what financial restriction is preventing stocks from increasing at all? The expert's opinion is that just because it's hot outside doesn't necessarily mean that the situation is stable. If the hygienic pandemic had occurred when the world economy was less indebted and had higher interest rates, things might have turned out differently. The majority of countries failed to take advantage of the favorable conditions to generate appropriate policy space because they didn't think the years before were good enough. Since the late 1990s, macroeconomic policies have gotten looser during the bad times and even freer during good times. She thinks that strong macro policy support is absolutely crucial in the face of a once-in-a-century global health pandemic. Regulations were low and debt levels were high even before the crisis started, which is the problem. This suggested that the banking crisis and the world economic crisis were simply accelerated by the disease's spread. In other words, according to MMT's guiding principles in the current state of the world economy, there cannot be inflation without a budgetary constraint. For the duration of the epidemic, fiscal and monetary policy may offer all the support needed and more. As was the case in the years following the global financial crisis, there will not be any rush to tighten these regulations, ostensibly to avoid jeopardizing the recovery, even in the event of a sanitary outbreak. After all, this is the reality that Japan has been enduring for the past 30 years. No matter how brilliantly or how poorly the global economy is performing, macroeconomic policies will eventually lead to inflation. Of course, the longer it takes, the more reliant markets are on the assistance of macroeconomic policy, which simplifies the inevitable adjustment. Even if central banks are willing to exceed their inflation target, non-linearities can make it challenging for them to succeed. His claim that "I'm so gloomy, I'm optimistic" on the market in recent years is made possible by low inflation. Due to this, the Fed will take all necessary measures to prevent inflation from becoming a financial burden. Therefore, this balance will be disturbed by inflation. According to him, the central bank is the most evident barrier. He does point out that there is no justification for such suffering as long as inflation is kept low and policy rates are held at zero by central banks. But this is still a situation of cyclical bubbles. Because of this vicious cycle of rising debt levels, falling interest rates, and expanding central bank balance sheets without inflation, as well as weaker real economies and worse asset price bubbles as a result of the Fed's policies, this previously unheard of economic crash will be exacerbated to a completely new degree. Because structural forces like globalization and information technology were becoming more powerful, the 1990s most certainly had low inflation. According to Van Vokatus, macro policies over-loosened as a result of using the low inflation as an excuse. As a result, the inflation rate stayed low. The analyst's statement that the endgame is uncertain but unlikely to be simple says a lot about what we will encounter in the next days. This banking catastrophe will occur even if the majority of governments and central banks are aware of the risks or possibilities as the 1% may refer to them. Tightening efforts have in the past failed, leading to sudden swings in the market. For example, B of A mentions the Fed's QE taper tantrum and abrupt turnaround. The Fed's decision to cut rates and expand its balance sheet even though unemployment is well below the natural rate, and the ECB's dilemma of being caught with negative rates. Despite severe negative consequences and the crisis end last year with the reintroduction of QE at almost full employment, despite the up until now market fervor. Athanasius draws the conclusion that the B of A wouldn't begin from this point and that there is no easy way out due to the current state of the global economy, which is poor and getting worse with each shock. The situation didn't look hopeful prior to the sanitary issue, but since it began, things have radically become worse, and this cannot go on indefinitely. In essence, this is what the general pattern that brought us to where we are today. So having all those presented to you, let me ask you guys a couple of questions. What do you believe will ignite the final economic collapse? And do you think we can still recover from all this? Feel free to jot down your thoughts in the comment sections below. If you enjoyed today's video, please leave us a like. And if you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.